In yesterday's video, we talked about how a whole lot is changing with regards to markets and the economy, but today we saw a lot more of the same. Considering last year we played to the tune of 120% returns, I think we're more than happy to see more of the same. And let's go over what we saw when we say we saw more of the same. This morning, we saw Kashkari, a former very dovish member of the Fed, come out and be very hawkish, say he expects a 5.4% terminal rate, saying the Fed's going to have to hike at the next several meetings. And then we got JOLTS data, which was pretty hot. We had more jobs open than expected. This is not what the Fed is trying to see. They're not seeing budging here. They're still seeing a high quits rate. And then we got the Fed minutes, which were very hawkish, unanimously hawkish amongst all members of the Fed. And we've seen this story before. You know, the market discounts the Fed, thinks they can fight the Fed successfully, thinks, oh, the Fed got this wrong. They were saying rates were going to be low. Now they're high. Ha, look, the Fed can be wrong. They're assuming that because it happened then, it's going to happen again. That the Fed is just always in a constant state of motion where you have to bet against them and do the opposite. I certainly agree they made a mistake, but I'm also aware that the phrase that you use in the market is don't fight the Fed. I mean, you didn't want to fight them on the way up, right? Obviously. You didn't want to fight them on the way down because that's what a big part of what's taking the market down. The economy is obviously holding up to some extent. Jobs obviously holding up to a very strong extent. Oil prices, they're flying all over the place. But energy stocks holding up. We talked about yesterday why we think Exxon, even at $70 a barrel, is still a very cheap stock. I mean, yes, and we don't expect, at least I don't expect, oil to be holding these levels for very long. I think we haven't broken 70. I think that was the floor. We're doing some sort of pullback. We're washing out a lot of paper traders, a lot of weak hands beginning of the year fearing a recession. Obviously, a recession trade going down, the 10 years being bought, it's pulling back. Okay, fine. We're not unfazed by a little volatility in the first couple trading days of the year. I mean, this is almost to be expected. We got to stick with the fundamentals, and the fundamentals remain OPEC seeing more demand growth than supply growth. They're still missing their quota. Yes, I get it. There was a little bit like a 20,000 barrel increase month over month. It's basically nothing. What matters is the future, and there are a lot of job openings in the United States, which is the largest consumer of oil. There's not a whole lot, in my opinion, to be concerned about with oil consumption. Yes, the price of oil did fall dramatically in the 2008 recession. It came back very quickly and hit new highs that I just last year broke for the first time since 2014. We had a very strong oil market after that pullback. But if you actually look at the oil consumption during the 2008, 2009, 2007 financial crisis, it pulled back, but not very much. Look at worldwide consumption, not very much, not very big of a pullback. So oil, yes, it will have some effect, but my understanding of why oil pulls back in recession is not applicable to today. Why is that? When you lead up to a recession, there's inflation. We saw that. There's a strong economy. We saw that. And when you see inflation and a strong economy, typically oil companies invest and fight over who can meet the market supply. They just whoosh in. And then you see a little bit of a pullback, and then all of a sudden there's a massive excess supply as all this investment in new supply begins to come online. That is not the case in this environment. Everyone from U.S. producers to OPEC has been incredibly disciplined. And I think this is the first time in history that's occurred, because when Trump was president, the American companies were incentivized to drill, baby, drill. And OPEC was hating on them. It was OPEC versus the U.S. producers. The U.S. producers were this new enemy. When COVID happened, was Russia versus Saudi Arabia. Who's going to take how much of the cuts? Who's going to get the money today with the oil that they got? Who's going to cut what? No, screw you guys. We want to produce. Now there's coordination. There's common understanding. We don't want to invest too much. We saw prices get high. We saw artificial selling, SPR release. We didn't want to deal with that. We just want a normal energy market to work in our favor. That's what these OPEC energy companies are saying. So I think this is a shakeout amongst paper traders that own these contracts, that want to avoid some sort of negative $37 a barrel situation. It's very difficult to actually trade these contracts. We just stick to the stocks. And the price of oil is down 4%, and many of the stocks are up today. That should tell you a lot, because it's much easier to own a stock than it is to contract, although they're supposed to trade in tandem. When the contract is having a liquidity crisis or something like that, yeah, there will be a deviation, which is what we're seeing today. Hopefully that deviation will end soon. We won't break 70 per barrel. I need to remind you that is where the SPR will be released. They've already announced one SPR refill purchase. So I think we're going to be okay in the clear. And this is an area I still like, energy stocks. More of the same. So I don't know if the market's going to rally or not from here. I think I'm not buying to play the rally. I'm not saying that I'm trying to play this rally. I still think there's more room to go. I'm not a super short-term guy. Yes, I will buy the weekly to 2 weekly to 3 weekly call option every now and then, here and there. CPI next week, it's probably going to be low. There's going to be a ton of people clamoring about how 0.1% month-on-month inflation annualized is very low. The Fed is over-tightening. The Fed expects inflation to be very low at the end of this year. They continue to say, and okay, you hear that? The Fed knows that inflation is going to be low at the end of the year. We'll see what happens with oil prices, though. Anyways, the Fed expects low inflation, and yet they're saying no cuts in 2023. They keep trying to push more hawkish. We have to acknowledge this. It's a different paradigm. It's not going to return to normal next year. It's not going to return to normal. It just does not seem like that's the case. Who knows what's going to happen? But the Fed is currently saying long-term interest rates are higher than the interest rates we've had the past couple of years. So get used to that. Why might this be the case? Labor supply, it seems, is a good argument. There's a different dynamic. Services inflation might just remain sticky, and interest rates just might need to be a little higher. I mean, they might need to be at 4% versus 3% in the 10-year, as it has been the past several years or so. Will that end the world? I don't think so. Will that drop multiples by 5 to 10%? Yes, that's a fine thing to happen when you're getting a slightly better interest rate. I would think that, some people would choose that slightly better interest rate over taking risk. We don't want the U.S. Treasury sucking up all the money of the economy. And that's what has happened with low interest rates, because the kind of risk you're taking to get a 5% yield when the 10 years offering you 2%, it's not worth it. But when the 10 years offering you 4% and you can take a 10% risk, that is a little bit better, or even 11 or 12%. I don't know exactly if it's going to work that perfectly, but you get the idea here. So there's definitely benefits to higher interest rates from an investor perspective, for sure. From an economic perspective, for sure. It's been a crazy world the past several years. The time of free money is coming to an end, and there are areas of the market that will benefit from that, and there are areas of the market that will not. So we're going to avoid the areas of the market that will not. That is extremely expensive tech stocks that require endless money. a lot of these companies are going to go bankrupt. There's going to be a wave of bankruptcies. Yes, technology is a great thing. Yes, we want to be innovative and speculative in our bets, but we don't want them to be too expensive. You know, we see companies that grow too fast. I don't know if you remember, Peloton. That was an example of too much money being actually a bad thing. They had a valuation run up too much. They had to grow too quickly to justify that valuation, and it screwed up their long-term development. So we need things to be a little more natural, and there's certain areas, there's plenty of areas that basically everything's still unnatural. Energy valuations are still unnatural. Some tech valuations are still unnatural. Although it is getting better, it is still not all the way there yet. So that's today's video. And until tomorrow, peace out.